Over $1.5 billion. That's the staggering sum analysts project consumers could pour into the latest wave of digital engagement traps this year alone. The Splatoon Raiders Direct just revealed a blueprint packed with features designed to accelerate that spending, laying bare a new frontier in the economics of player exploitation. This isn't just about fun and games, it's about the sophisticated financial engineering baked into our entertainment. We're talking about systems crafted to maximize time investment and recurring revenue, often at the unseen expense of players' wallets and well-being. What appeared on screen today was more than just new enemies, weapons, and tanks. It was a carefully constructed strategy for sustained financial extraction, one that many Wall Street observers are watching closely. The implications for household budgets, particularly for families with young gamers, are profoundly unsettling, hinting at a future where leisure comes with a far steeper, and often hidden, price tag.
What we saw wasn't just a game announcement. It was a masterclass in behavioral economics applied to entertainment. The extensive customization options, the promise of powerful weapon upgrades, and those new, intimidating tank classes, they all serve a singular, profit-driven purpose. Industry observers, many within Silicon Valley, are now scrutinizing how these mechanics are crafted to maximize player engagement, often blurring the lines between pure enjoyment and financial commitment. These aren't simply cosmetic choices or optional enhancements. They're strategically positioned pathways to continuous spending, designed to feel increasingly essential for competitive play or even basic progression within the game's expansive world. This is precisely where the line between premium content and potentially predatory design becomes dangerously thin, raising urgent alarms for consumer protection advocates across the globe. It's a system engineered for persistent interaction and monetization, a digital treadmill disguised as thrilling adventure. Bloomberg's own reporting has consistently highlighted the escalating financial commitment demanded by modern gaming's live service models. We've seen countless studies, often cited by firms like Gartner and McKinsey, detailing the psychological triggers behind impulse purchases and the effectiveness of scarcity tactics in virtual marketplaces. These aren't abstract theories. They're proven methodologies, meticulously refined by data scientists to optimize revenue per user. The Raiders Direct showcased a sophisticated ecosystem of new enemies, each potentially requiring specific counters, often tied to advanced weapon tiers or tank loadouts that demand significant investment. This creates a perceived necessity for upgrades, a relentless treadmill of acquisition that industry data confirms can lead to significant, unforeseen outlays for players. The mechanism is clear. Introduce a compelling challenge, then sell the solution repeatedly and persuasively, ensuring a constant churn of spending that few truly anticipate when they first engage. It's a finely tuned machine designed to extract value. Here's what nobody mentions amidst the fervent hype surrounding these grand reveals. The true cost isn't solely the initial game price, or even the direct microtransactions. It's the insidious opportunity cost, the mental bandwidth consumed, and the potential erosion of financial literacy, particularly for younger demographics navigating these complex digital economies. The Raiders Direct presented a vision of endless content and thrilling escapism, but for many, it subtly morphs into an endless commitment, a demand on resources far beyond mere entertainment. Policymakers in both the US and the EU are increasingly scrutinizing these pervasive practices, recognizing the delicate, often breached, line between engaging entertainment and engineered addiction. Protect your wallet and, crucially, your time. Understand the sophisticated psychological and economic strategies at play before you dive headfirst into this new, captivating, yet potentially perilous digital frontier. For more in-depth analysis on the evolving economics of gaming and its societal impact, make sure to hit that subscribe button and turn on notifications. Wall Street isn't just watching the flashy reveals. Leading economists are sounding alarms about the deeper currents at play. Concerns ripple through financial forums, from the Federal Reserve's latest reports to discussions among IMF strategists. They're scrutinizing the economic model underpinning these elaborate digital experiences, not the pixels on screen. Many point to an accelerating trend where digital content, once a leisure expense, now demands a disproportionate share of household budgets. This shift, say analysts from firms like Gartner and McKinsey, could introduce unforeseen volatility into consumer spending patterns. It's a subtle but significant reallocation of disposable income, with potential ripple effects on traditional retail and service sectors. Financial stability groups are starting to take note, fearing a broader economic impact. Beyond American shores, a different kind of tremor is being felt. European regulators, long wary of digital market power, are openly discussing new frameworks to address these emerging economic models. We're seeing early indications of legislative pushback in Brussels, driven by consumer protection advocates. Across Asia, particularly in markets with high digital engagement, central banks are monitoring capital flows and household debt figures with renewed interest. There's a growing debate among G7 nations about harmonizing approaches to digital economy oversight, aiming to prevent regulatory arbitrage. The global conversation isn't about the game itself, but about the precedent it sets for digital consumption worldwide. It's a race to understand and respond before these models become too entrenched to manage. Cast your mind back to the dot-com bust of the early 2000s, or even the subprime mortgage crisis. We've seen periods where speculative fervor, fueled by novel financial instruments, led to widespread economic pain. While the context is entirely different, the underlying mechanics of rapid value creation and consumer indebtedness bear an uncomfortable resemblance. Past digital asset booms, initially hailed as innovation, often ended with significant investor and consumer losses once the speculative bubble burst. History shows us that when opaque value systems meet eager consumer bases, the outcome can be a brutal correction. The lesson is clear. Unchecked enthusiasm for new digital paradigms carries substantial, documented risks. Look closely at the economic landscape, and you'll find unexpected beneficiaries and silent casualties. The obvious winners are the platform holders and the content creators at the very top. But consider the ancillary industries, data analytics firms processing vast quantities of player behavior, or payment processors handling millions of daily transactions. They're quietly raking in massive profits. The real losers? Small, independent game studios struggling to compete for dwindling consumer attention and budget. Families, students, and those with limited disposable income often face the brunt, diverting funds from essential needs to keep pace. Even traditional entertainment venues, from cinemas to live events, could see their audiences further eroded. It's a zero-sum game for consumer wallets.